Well, Bob, rumor has it September is historically the worst month in the market. And of course, it's a Tuesday after Labor Day. If you can't hear me talking well, it's because I was at the Oasis concert screaming my head off yesterday. So it's not because I was on a bender, just for the record.
And those guys are still alive?
Still alive, and they put on a phenomenal show, by the way. Amazing show.
All right. Actually, the most amazing thing is that they don't get along and they're still touring like they've survived this long.
Well, actually, they came out like hand in hand. So they were, I guess they were, I think how they rekindled it was, so I saw these stats. So for just the 4 shows that they did in England and Ireland, how much do you think each Gallagher brother got paid? Just for those 4 shows. Now there's 41 shows on the whole tour, but just for those 4 shows.
Couple million.
How much?
Couple million.
Couple million. Bob?
$200,000 each.
$200,000 each? Okay, Courtney?
I don't even have a frame of reference for what you'd get paid for this. I don't know. Couple million each?
Yeah. 50 million euros a piece. For those
out of
4
here.
shows.
Wow.
A piece.
You know, brother, I think it's time to go on the road. How much were the tickets to get in?
My seats were $450. And that was a face value ticket. That wasn't even a markup. And that probably held called 50 to 60,000 people. But it's a 42 show tour, and they're estimating between merchandise and everything else, it's going to be over $1 billion they're going to generate on their tour.
It's crazy because after COVID, everybody started doing experiences instead of buying things. And everyone thought, oh, that's going to fade. This is just a temporary thing. Once life gets back to normal, that's not going to be the case. But clearly people will stay a premium for these experiences. People just don't want to live life right now, which I find interesting.
No, also, I'll tell you what's interesting too is, so there's this place called the Mall of America, which I've never seen it before, but it's huge. It has a huge Ferris wheel, has
an
ski area and everything else. So we went there for food before the concert, and the place was packed. So anyone who's been telling you about a recession, I'll tell you what, consumers are consuming. You don't have to look any further than the Mall of America to do your economic research.
Take a couple runs in the slopes.
I was take a couple runs in the slopes for the concert.
Welcome to the weekly edition of the Payne Points of Wealth podcast, the podcast that addresses all the pain points that come along with creating, growing, and sustaining your wealth. Hosted by the family wealth experts of Payne Capital Management, Bob, Ryan, and Chris Payne. Please send us any questions or comments you may have to questions@paynecm.com. And please enjoy this week's episode.
But it brings us to the question here, Bob. Obviously it looks like the economy still looks pretty strong to me, just based on my anecdotal evidence of going to the Mall of America. But, you do get a typical swoon in September. So the question is this a time to get out of the markets, get on the sidelines? A lot of uncertainty right now around tariffs. We have a lot of uncertainty around what's going to happen with interest rates. So do you just sell and maybe sit on the sidelines and wait for things to cool down?
Well, I think, anytime anybody advises you to follow the seasonality, right? So you take, let's say statistically, September has been the worst month. When you average it out, over the period of time that we have records, it has averaged, negative 0.8%. But there's been some huge declines in September. So it's 50-50 actually. Half of the Septembers are up, half are down.
So I got it, Bob. The strategy here is you flip a coin. If it heads, you stay in. If it tails, you get out of the market. But I think, the big question right now, Courtney, is, and we talked about this on the last episode, is really what's going to happen with interest rates. And we saw a big, what we call pivot from Fed Chairman Jerome Powell back in, I guess August, which is only a couple of days ago, at the Jackson Hole Summit, basically alluding to he's pretty open to cutting interest rates, yet we still have 2 big pieces of economic data come out. What's your opinion? Do you think the Fed's going to cut rates come September 17th?
It's pretty widely expected the rates are going to come down this month, which is a really good thing for all of your short-term debt. So think if you have credit card debt, that's actually a good thing. You're going to be paying less on that. This is good for businesses who lend money short-term or borrow money short-term. But I think the irony of all of this is what we were talking about last week is even if they lower rates, which they probably will, this could actually spike longer term inflation because it can stimulate the economy and create a lot of this growth. So even if inflation comes down immediately and they cut rates, longer term is still an issue, which affects things like mortgage rates are not coming down right now.
Well, I sure hope interest rates come down so Ryan can pay off the credit card bill that he charges Oasis tickets to. There's APRs. That APR can get pretty sticky sometimes.
Sure, I might be sleeping on Chris's couch. But no, I think it's a good point. So you're saying definitely rate cut comes September 17th. Got it. And I think this is a really good point. Chris, and you talked about this the other week too, is just that it doesn't necessarily mean that mortgage rates will actually go down because the Fed doesn't control long-term interest rates. So there's a good chance they'll go up, and that could actually continue to keep the housing market kind of on lockdown, right? Because people aren't buying right now and sellers aren't selling, essentially because they've been waiting for interest rates to come down. That might not actually happen.
Yeah, I mean, I've actually seen in a lot of cases, places for sale, they've actually come down in price. So I don't, that housing market certainly is not expecting, potential cut in the interest rates.
Well, I mean, it's going to be interesting to see. Bob, would you take the over or under on that? Do you think the Fed's going to cut interest rates, or do you think that the, futures market's being way too optimistic right now and the Fed's going to stay pat? Maybe that labor market number is going to come in strong on Friday, and maybe that inflation data is still going to look strong when that comes out in another week or so.
Well, this comes under the Payne Points of Payne Principles of Wealth, is that nobody knows. Come on, nobody knows. Nobody knows what the job number is going to be. Markets don't look backwards; they look forward. So we have 86% of the futures traders are saying we're going to get a cut. I think they're probably right, but you look at the economy. I mean, GDP now is estimating a 3.3% GDP for the quarter. That's spectacular. And if you have GDP going up, you have earnings going up. Earnings have been coming in, way above, the analyst estimates. And, we just had personal income rise and retail sales went up, as you said, right? You witnessed it firsthand. Retail sales is booming.
I think what's interesting too is if we rewind here and we were looking at end of last year, it was expected there was going to be 6 rate cuts this year. And we're now in September talking about the very first rate cut. But the markets have done fantastic this year, right? Like they're at all-time highs, which I think is really interesting that we came into this year assuming there was all these rate cuts. They haven't happened. Economy's still done well. But I don't think the economy needs these rate cuts. So even if this doesn't happen, if this is wrong, I don't think that's a bad thing, but it is helpful in the short term if it does happen.
I mean, it seems like that's a recurring theme. I mean, last time that they had a rate cut, the same thing happened. The economy still continued to thrive. We really didn't need it.
Yeah, exactly. And, Jerome Powell found some whatever metric he found, which he said the labor market was actually weakening last September. And we found out it wasn't. So now he's starting to kind of play the same story. I think he's just caving to Trump personally. I think the man has no backbone. It's my personal opinion. But I think it was what Courtney, you just said it perfectly right, is regardless of if we get a rate cut or not, economic conditions are very, very good. Market's already hot. Actually, I would say the economy's warming up. We know the stock market's warming up. You're seeing margin debt, that's like borrowing against your portfolio, hit a record $1 trillion. So that's people just speculating options activities at some of the highest levels we've ever seen. So you have capital markets heating up. We know the economy is relatively strong. Could the Fed be just spiking the punch bowl? And you're supposed to take the punch bowl away when economic conditions are heating up, is what I've read.
So, right. Sounds like to me, sell in May and go away and, avoid September. It's the worst month of the year. I think the IRS is the ones that come up with these seasonality ideas because they want you to sell your portfolio so you can pay capital gains tax, right? And basically we've been in a big booming bull market, right, since we launched Payne Capital Management. So all these people are doing is self-imposing taxes, voluntary taxes. So I think that seasonality is the voluntary tax on the stupid. What do you think?
Bob, I like your conspiracy theory in there. And I think, bottom line is here, look, from everything we're saying today is regardless of what happens, whether the employment number this Friday comes out stronger, a little bit weaker, if inflation comes in a little stronger, a little weaker, if the Fed doesn't cut, it doesn't really matter right now. The fundamentals look very good from where we're standing. The worst strategy you can make is the seasonality strategy. You got to be in it to win it. Time to be bullish. So, Bob, you and I were talking, and one of the things that really bothers me, just gets under my skin, is all of a sudden we know technology is just having a phenomenal year. NVIDIA is up I did the calculation on this, over 1,000% over the last 3 years, since October of 2002. And of course, that's right when ChatGPT came out and this whole excitement around AI started. And that year, people forget, but NVIDIA went down 50%, right? And if you go back, there was no analyst that was pounding the table saying, you must buy NVIDIA now. This is going to be the future. But now everyone on TV is just acting so nonchalant, oh, of course, I've owned these stocks forever. And of course, you should own NVIDIA here. Of course, you should own the Magnificent Seven here. And it's just frustrating because, all right, we're already talking about what market's been hot forever. And when we talk about good investing, Bob, is your opinion that you should only buy what's already has momentum? Bob, do you think that's the best investment strategy? Just buy the momentum trade from these people that pretended like they've owned these stocks now for several years, even though they're all crying recession and being bearish for the last couple of years? It's kind of annoying, frankly.
You're kind of like the hipster that's like, oh, I heard the band before they were popular.
We were bullish on this podcast, for the record, for the last couple of years when nobody else was, but now everyone on TV acts like they've been bullish the whole time.
Well, the problem is, I think the question we all have to ask, since we've been doing this for quite some time, have investors evolved? Are they better now because we have better information? There's more access to markets. Do you think investors have evolved and they're better investors now? What do you say to that?
That's a hard no. And I think that's the one thing. And I think we know this, right? I mean, we deal with people's human behavior every single day because we have clients that are investors. And Courtney, now you've been in the business for what, over a decade?
Mm-hmm. Yeah.
Man, you've been around a long time. I think it's a question, dude. Do you think that investors are getting smarter with all the technology we have, all the information? Because a lot of people are saying now the retail investor is actually smarter than the institutional investors because they went and they bought back in April when the institutions weren't. So maybe it's true. Maybe the retail investor is getting smarter and they don't need you and me.
What I like about the retail investors right now is they're getting invested. Like, not investing, especially these younger generations, just holding money in cash has been a story that's been around for a long time. But in order to get ahead and retire, you need to be investing. So that story I love. What I don't like to hear, though, is when people are investing in really risky investments and the amount of margin people are taking, putting out loans to get even riskier in their investments. That makes me nervous. And it works really well right now when you're in a bull market and things are doing well. But when it goes the other way, that can actually really work against you. So that's what makes me anxious about the retail investor right now.
I actually think we have a crystal ball because I think like a year ago, we were talking about like how all this money is going to get back into the market and it's going to go to like the Magnificent Seven. Everything that's going up, like it's kind of like looking for love in all the wrong places.
No, it's totally true, right? Because we said this a year and a half ago. Remember, we were getting 5% on a money market fund. And every strategist said, oh, well, having cash is a strategy. Well, it wasn't, because your 5% got cut. And, now we're down to what, less than 4% on a money market fund because the Fed's been cutting and they may continue to cut. And now all the money's funneled into the market. And we know historically, when retail investors get very bullish, you're not at the beginning of the trend. You're getting close to the end of the trend. And the reason I know this is, we remember this, guys, but the last decade was considered the most hated bull market of all time. Chris, you remember, because it was so hard to get people to be invested in the stock market, and the market went straight up.
Yeah, everybody was second guessing themselves. And by the way, having money in cash is a strategy. It's a bad strategy, but it is a strategy.
Well, when I used to conduct my seminars back at Old Mother Merrill, I'd always start the seminar with, why isn't everybody rich? Right? It's just, there's a formula, right? Building wealth is not that difficult, right? It's, if you think about it, investing is a problem that's been solved. So, we have a tried and true method, to help people create wealth. And why doesn't it work for some people? Well, because they can't help, looking for that get rich quick scheme, right? That shiny object, whether it's Bitcoin or Nvidia or, concentrating in the Mag 7, which, by the way, guys, based on performance relative to everything else in our portfolio, I have a new name. It's the Lag 7. It's lagging performance this year. People are not killing it with the Mag 7, even if they have, and a lot of people do, have a huge concentration, in that area of the market.
Here's the problem with the psyche. It's kind of like, okay, that's what's hot right now. That's where I should put my money. I was just talking to a friend the other day whose uncle may get like a huge settlement from a lawsuit. Never been invested in the market. He says, all I know is if I get that money, I'm putting it in Nvidia. So I think that's where the rationale is right now. But we know the best time to buy a market is before it goes up. And there's no one on TV saying, look, at some point, tech trade's going to end, right? And money's going to rotate somewhere else. And what good investing is thinking about, where do I put my money now so when that money finally rotates out of tech, then I'm benefiting from that. And it's funny, I saw this. Warren Buffett, he added money to those Japanese trading companies that he owns, which are like mini Berkshire Hathaways. He's not buying Nvidia. He's thinking about, where's the money going to rotate next? And I think that's what gets missed right now. That always gets missed when people are allocating money. They're looking at what's hot And that's not how you really create wealth. You buy before the market goes up, and nobody's talking about that.
Well, that's the hard part about when the party's at its height. Nobody's looking for the exits.
When you look at your portfolio, if you love it right now, I mean, really love it, you can't wait to talk about it, you're in trouble. You want to have, because the best valuation is something where earnings are growing, right? Where, there's liquidity in the market, but it's hated, right? When you bring it up, it's like if you're on CNBC and they go, "Oh, not small caps again, Courtney." I mean, they're uninvestable, right? China was uninvestable a year ago. Now it's up 100%, 200%. So it's really great if you get pushback from your clients on what to invest in. But, to me, you've got Ferraris that are on sale right now at Chevy prices. And people want to pay up for the Ferrari and wait 3 years. As a matter of fact, if you're all Mag 7, I'm going to make a prediction. You're not going to make any money for the next 5 years.
Yeah, I mean, we talk a lot about the Mag 7. We've just spent the last several minutes talking about this, which is what the news focuses on also. But I think what's interesting is that is not the best performer this year. Like, we all get excited about that because that's like exciting and it's tech and it's AI. Europe and emerging markets have way outperformed all of our tech companies. So as exciting as they are, and they are doing well, they're not the best performer. So even if, maybe they don't have a downturn or maybe they're not negative in looking in the future, but it doesn't mean it's going to be the best place to put your money. This year it hasn't. And I don't think a lot of people realize that.
Well, I think it comes down to, look, the tech trade can continue to go up, but we know things are going to change. We don't know how, we don't know when, we don't know why. So you just have to ask yourself, when things do change and money does rotate, am I in those other places that are going to benefit? And I would argue for most of you, the answer is no. And the time to make those changes is now, while the wind's at your back, before the change actually comes. Hey, hope you're enjoying the most recent episode of the Payne Points of Wealth podcast. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million for your retirement, Bob, Chris, Courtney, and I will run for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We'll go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life and hone in on every financial issue you need to address today, whether it's an income plan for retirement. How do you take Social Security? How do you draw from your portfolio, factor in inflation, and don't run out of money? We'll look at diversification. Markets have been wild over the course of the last couple of months. Has your portfolio been up and down? Or have you been sitting in cash, CDs, money market funds, paralysis by analysis? We'll put together a full investment game plan. We'll show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, insurance product, structured product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get a full tax playbook, and we'll do this full review at no cost. We'll literally go through everything for you, do all the work up front. Simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. All right, it's the financial autopsy. This is where we break down a real financial plan and we look at mistakes we all make when it comes to our financial planning and talk about how to correct them so we can make better decisions when it comes to financial independence. And Courtney, you worked on a case recently. Let's dissect it.
Yeah, so just to give you some background here, this is a couple who's just about to retire. So they've done a really good job of saving for retirement. They have this really nice nest egg. But one of the biggest problems, the first thing I noticed when I saw this couple is they're too conservative. They have over $4 million in assets, but about 1.2 of that was just sitting in a money market fund, getting no growth, just the current interest rate.
Court, I think every case I ever worked on in my career, I think the biggest question every investor, every saver, every person we're planning for is, am I taking too much risk or am I not taking enough risk? And so how do you solve for that?
Yeah, so we actually model this out and we back test this. So inflation is your biggest enemy in retirement. And that's actually one of the biggest issues I see right now is people are enticed by this 4 to 5% interest rate you're getting on your money market, but that is short term. As soon as the Fed starts lowering rates, you're not going to be getting that 4 to 5% anymore. Plus, you're paying taxes on this. This couple isn't in a low tax bracket. So we back tested those things. So yeah, that 4% looks great. If that lasts forever, it probably won't. We want to see what that looks like for you.
Yeah, it's pretty amazing when you look at, once they start doing RMDs, required minimum distributions from their retirement accounts, they're going to stay in a reasonably high level of taxation. And, municipal bonds would probably be a great solution here.
Well, also, you think about it, let's do the simple math on this. If I'm getting 4% in a money market fund, well, you're paying taxes on it. So maybe you're down to a 3% return after tax, but then inflation's 3%. So you actually have a 0% return. And one of the big things we solve for is your money literally has to grow over retirement so you can keep taking income from it because your income needs are going to go up, Chris.
Yeah, the cost of healthcare is a big issue, especially long term. And right now, I think the stat is that for a male, the average cost of healthcare in retirement could be up to $1 million.
And that's your standard care, right? That's not talking about long-term care, which is different. So this is when you get older. If you need to go into some sort of like assisted living facility, you need to have an at-home nursing care, that can really drain assets very quickly. And that's actually something this client had brought up is we don't have any long-term care insurance. We want to make sure we can plan for those things. But that's just another reason of why you don't want to have too much money sitting in a money market because that money down the line needs to be growing. Those costs are rising faster than inflation.
Well, and how many of us are actually putting our portfolio to the stress test when it comes to retirement, right? How many times has someone actually said like, oh, let me plot in there how much I'm going to need for healthcare costs later on, right? That barely ever gets put into someone's plan. Never mind, well, let's say I need, I don't know, $100,000 a year today. Well, in 20 years, you're going to need $200,000 a year. So I think it's a really good point, Courtney. It's like you have to put in every possible expense someone could have. And this is where it becomes a problem right now, because I think with most people that we see coming in the doors, either they're taking way too much risk, which we talked about on the show today. They own too much money in tech, too much money in NVIDIA, hoping that they're just going to hit one home run after the other, which has problems. But then you have the other extreme, and we see this all the time, where we see too many couples or individuals with too much money in cash not growing. And to your point, Courtney, there's so many expenses in retirement that most of us don't factor in.
And the irony of this is they're really enticed by the current income that you're getting on things like money markets, or if I can be conservative, I can get enough income. And we're not saying, oh, take a ton of risk in your portfolio. We were saying, okay, probably take about 10% more risk than you're taking right now, but we would actually about double the income they were getting. So this would not only make sure that they're growing to keep pace with inflation, but also the consistent income they're getting would be a lot higher when you're locking into bond rates right now, and the dividends that equities are paying are actually much more attractive than sitting in that money market. So the irony is they're getting more income than they needed and also getting the growth that they needed.
Yeah, and combined with the fact that you could use more tax-efficient investments, they could be realizing even more than that because they're not paying taxes on those dollars.
The other thing I noticed is when we look at the stock side of their investments, they had a very big overlap. So I'm looking at their top holdings here, and I think you guys could probably already guess what some of these are. But the top holding is Microsoft. The next is NVIDIA. The next is Apple, etc. But it's basically all the Mag 7. And one would think that you would be really well diversified when you have as many funds as they do. But I'm counting here, and there's 15 different mutual funds that all have Microsoft as their top holding. So all of those things together made up such a much larger portion of one stock than they realized they had. Because even though they had all these different stocks, they were all owning the same thing. And in the stock markets, it was mainly the Mag 7.
It reminds me of that old commercial, you know what's in your wallet? By Capital One, Bob. It's like, I think most of us have no idea what we own in our portfolio, especially when you have all these mutual funds that have different names, yet they own all the same things.
Well, that's a problem with mutual funds. They don't stick to their prospectus, right? You'll see a value manager drifting towards large growth because he's underperforming the S&P 500 index. Same thing happened back in the 90s. That's why I like ETFs better, because you don't have a portfolio manager who's going to underperform the market. Let's face it, guys. We know who's smarter, the market, not some analyst.
Chris would argue differently, but Chris, yeah, we see that all the time, right? I mean, why would nowadays, when we know that mutual funds are less tax efficient, right? Every year they have to pay out their capital gains. So even if you see that fund go down in a certain year, you could still be paying taxes on it. The fees are higher, like in this portfolio, all the fees are high on those mutual funds. They've underperformed the market. And go back to what Courtney's point is, they all own the same stocks. Like, why do people still own mutual funds? I don't get it.
I think it predominantly has to do with just not knowing. I'd say probably 90% of the portfolios that we look at all contain mutual funds. I seldom see a portfolio that's all low-cost index ETFs. There's also the myth that the manager potentially can outperform the underlying index, but Dad makes a good point. a lot of times you see these managers style drift. They just can't stay in their lane.
Well, I think it's something like 10% of money managers have outperformed the S&P 500 over the last like 10 years, something like that.
Well, like we work for the big firms in our channel, and that mutual funds fund a lot of meetings, for brokerage firms and wirehouses. So like anything else, investments aren't bought, they're sold. And if your financial advisor or your fiduciary is selling you mutual funds, they've probably been sold on the idea of what's in it for them.
Yeah, Courtney, I would say even more awesome on this. I'm looking at your analysis. Not only did you break down all the income they're getting paid now and all the fees from those mutual funds, but by using lower cost funds, getting the money fully invested as opposed to sitting in money market funds for a good quarter of it, you're able to increase their cash flow by $40,000 a year. So that's had nothing to do with the market going up or down, which is amazing. Just reallocating the portfolio strategically based on their goals and their income needs, you're able to bump up that income, which is much more certain than what the market's going to do year to year. Even though I know Chris has a crystal ball. Amazing.
And what's even better is they have put themselves in a really good position for retirement where they have enough income to support them. So what's really great about this is going to be more money than they actually need. So that's going to be money that they can reinvest. So even the stock markets do absolutely nothing. That's an extra $40,000 they wouldn't have had that they can buy more investments, which again is just going to compound and help those longer term goals down the line.
Hey, hope you enjoyed episode 216, Payne Points of Wealth. If you like our podcast, you know you love our podcast. Please give us that 5-star rating on iTunes, Spotify, so subscribe to our channel on each. Please don't give our podcast a secret. If you're watching this on YouTube right now, you can like this episode, subscribe to our channel, click that notification bell to be updated every week of all our new content. But your ability to let everyone know about our podcast gives us the ability to keep doing it. We appreciate your support. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Brian, and Chris's firm, Payne Capital Management, at BeBullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.